Welcome to our discussion of Chapter 10, where we look at standard costs and variances. So when we take a look back at Chapter 9, so when we finished off with that discussion, we had completed our flexible budget. And remember, the flexible budget was where we broke down those differences between the actual results and the planning budget amounts, between the portion of it that's due to an activity variances and the portion of it that's due to either a revenue or a spending variance. So instead of just looking at the difference between actual versus planning and stopping there, like we did with the planning budget, just finding those differences, we broke those differences down between their two components. So for revenue, that variance of $5,500 when comparing actual to planning, just that $5,500 variance was broken up between $1,750 revenue variance, favorable revenue variance, and a $3,750 favorable activity variance. So those two together add up to that overall variance between the planning and the actual number of $5,500. And we did the same for all of the remaining items. So for example, any of these cost items initially we found their regular variances between what we planned for and what actually happened, but then we break down those variances between what portion of it is a spending variance and what portion of it is an activity variance. And these two will always add up to the overall variance when comparing planning to the actual results. But now in Chapter 10 as a next step, we're going to take these spending variances and break them down into their component parts. These spending variances can be broken down into its price and quantity variance. And in Chapter 10, we'll also be looking at variances as it relates to fixed overhead, but we'll start our discussion with those variable costs. So let's take a look here. Standards. So standards, for the most part, when we think of a standard, it refers to a benchmark or a norm for measuring performance. Because if we don't set standards, how will we know how good we're doing or if we're actually improving over time? So a company will oftentimes employ a standard cost system where they actually establish standards beforehand and then measure their actual results up against these various standards. So there's usually two kinds of standards that we can break these down into. So standards can be broken down into price standards and quantity standards. So a price standard, that specifies how much should be paid for 1 unit of input. So when we're talking about materials, how much should we be paying for, let's say, 1 pound of material? Or in terms of labor, how much should we be paying for 1 hour of direct labor? And same with variable overhead. Remember, oftentimes overhead is applied on the basis of something like direct labor hours. So a standard regarding variable overhead might be what kind of cost should we be incurring for every hour of direct labor hours. So, but in that case, we're talking about costs incurred as a result of that labor, not necessarily the labor rate, which is what we'd be talking about when specifically talking about labor itself. Quantity standards, this specifies how much of an input we should use to make a product or provide a service. So we'll start with materials. Materials quantity standard will tell us how many pounds of materials, for example, we need to use to make 1 unit of product. Labor, quantity standard for labor would tell us how many direct labor hours should be used to make 1 unit of product. And then with variable overhead, again, how many hours will we need to use on 1 unit of product, and what does that then equate to in terms of overhead incurred for 1 unit of product? Now, when we look at a standard cost card, this looks at all those variable costs related to making a unit of product, and it shows the total standard cost of just making 1 unit. So what's the total direct materials cost, the total direct labor cost, and the total variable manufacturing overhead that we should be incurring to just make 1 unit of product. So that standard cost card is what we refer to measure everything up against when we actually have those actual results. So these spending variances that we looked at in chapter 9, they're useful on the surface when we look at these just as they are, but they're even more useful when we break those spending variances down into their price and quantity variances. So we're looking at that spending variance, what portion of it is due to a price variance, and what portion of it is due to a quantity variance. So price variance is the difference between what is actually paid for something and what should have been paid based on that standard price. Now, a quantity variance is the difference between the actual quantity of something used, whether it's materials or direct labor hours, and what quantity should have been used, given that actual level of activity. So there's different kinds of price variances here. So we have a materials price variance, a labor rate variance, and a variable manufacturing overhead rate variance. All of these are using the same general calculations. They're just called something slightly different based on what we're talking about. And then the types of quantity variances are materials quantity variance, labor efficiency variance, and variable manufacturing overhead efficiency variance. So in chapter 10, we'll learn how to find all of these variances, so all 6 of these kinds of variances, and we'll take it a step further into the appendix to find out variances as they apply to fixed manufacturing overhead.